Welcome to Landmark Talks Property, a podcast by Landmark Information Group that covers all things property in short and intelligent podcasts.
Hello, welcome to this episode of the Headline Property Trends podcast. Today we're discussing Landmark's Property Trends report for Q1 2026. It's fair to say it's been an interesting quarter of activity with several factors impacting what we're seeing in the property market, especially when what we're doing this quarter is, as we do every quarter, which is compare ourselves to the activity that we've seen in the corresponding quarter the prior year. So we're comparing ourselves to Q1 of 2025, which most of you won't need reminding, was a quarter where we saw a close of a stamp duty window happen at the end of March of that year. So there was a flurry of activity which impacted the 2025 stats, which I'm sure our panelists will come on to when they're talking about what they're seeing this year and the year-on-year comparisons. So it's an interesting quarter all round. We're looking at both England and Wales and Scotland. And so I'll first off introduce our guest today. And as I see it on my screen, I've got Richard Hepburn joining us. Richard is the Managing Director of Landmark Scotland. Hello, Richard.
Hi, Mike.
No surprise that Richard will be talking about our Scottish data today. And then next I see we've got Rob Gurney. Rob Gurney, Managing Director of Ochresoft. He'll be talking conveyancing today.
I will indeed. Hello.
And then last but not least, Ben Robinson, who is the Managing Director of Landmark Estate Agency Services, who will be talking all things estate agency today.
Hi, Mike.
So the first thing we'd like to talk about today is the cross-market activity we've seen across Landmark. Early stage activity looked to be improving in the quarter, supported by a 3% rise in listings and buildings SSTC volumes throughout the quarter. However, as I mentioned at the start, when we compare ourselves to last year, it was a very different quarter. So whilst listing volumes were up 3% on the same quarter 2025, SSTC volumes were down 8%. And completions down 18%. And I know that Rob will come and talk about completions later on, but that's driven by what happened in 2025 more than what happened in 2026. And then the final stat that we talk about when we look at cross-market activities is to look at search order volumes, which were down just 1% on the same quarter of 2025. So next I will come up to Ben to focus a little bit more on the estate agency side and what we've been seeing, starting with the listings, please.
Yeah, that's fine. Cheers, Mike. As you mentioned, up year on year, which is a good sign in a way, because ultimately the supply is the start of demand. It shows an intent to move, so people still want to move. That does mask a little bit more of a story in that when we spoke at the end of last quarter, we'd seen a subdued final quarter of 2025, and there was an expectation maybe there was some pent-up supply from that. Obviously, there was the late budget, and that was the market was telling us, and from what we could see, that was putting people off making a decision into the new year. And looking at the trend this year, that would I say that our prediction came true, in that January was actually up 6% year on year. So it was January that did most of the heavy lifting in the quarter in terms of being up year on year, albeit the overall trend does say 3% up. And it almost entirely reverses what we saw that we were down actually in Q4 of 2025. So we're back to level playing field in terms of supply, but lots of properties for sale, people still coming to the market. As I said before, there is intention to move.
Thanks, Ben. And can you tell us what that does for demand supply variance, and also remind anybody or let any new listeners know why we measure demand supply variance and what it means?
Yeah, so really it's just comparing the ratio of demand strength against supply strength, because of course for a healthy market they should be in balance. We do that a number of ways, and one of the ones in the background that we measure is actually just a straight percentage, so of what's listed, how many are actually sold in the month. And unfortunately, through the quarter, although it did recover somewhat, almost following the opposite pattern to supply in terms of January being subdued and then recovering back, it does look a little lower on the demand side. Now, Some of that could come from last year. And when we look at it as a comparator, we do have optimistic and ambitious people in this industry, and we know we're coming up to a stamp duty deadline. So even perhaps in January, and again, we can see that it was January did the heavy lifting in terms of being down year on year on the demand side. And you could maybe see that some people were still trying to push that if they were sold in January, they'd be through before the stamp duty window. Unlikely, as we know. Maybe one or two did get through, and perhaps that's the reason. Obviously, though, there is some uncertainty certainly creeping around at the moment. So as we've seen it pick up, it will be interesting to see how that ratio trends moving forwards. Because from what I see in March, and on the latest figures in March, that demand-supply ratio wasn't particularly strong. If normally we're looking at a percentage in a healthy market, 75 to 80%, post-COVID up to 90%, immediately post-COVID, mini budget down to low 60s. March is coming out about 66%. So that suggests a weaker month. And I think I've got 7-8 years of data, and that's the weakest we've had in terms of March. And obviously that some of that could be the uncertainty we're seeing out there in the wider world and people are failing to make a commitment. And of course, that does have an impact on the market as a whole. If people have an intention to move, they come into the market, but there's too much supply and not enough people committing, of course, that puts pressure on price. It puts pressure on price, and it means that we have a buyer's market. They've got lots of choice, and when they've got lots of choice, they could be fussier, which actually puts pressure on security of the pipeline and speed of the pipeline, because people can take longer to make a decision and actually can make a different decision if they find something that they're really not happy with, or even if it's just a bit inconvenient on the current property, there might be something else for them out there. So difficult trading conditions, I'm being told, in terms of getting that commitment downstream, and our numbers certainly belie that, even if that stock coming to the market is healthy.
Fantastic. Thanks very much, Ben. Rob, I'll come to you next. Can you talk us through the conveyancer market activity in Q1, please?
Sure. And we'll get straight down to business and look at the numbers. So SSTC levels for January and February 2026 were down 10% and 8% respectively year on year. And March, you could see the SST volumes building steadily, despite them being sort of lower than the previous calendar year. March ended up being 7% down versus March 25. So we went from being 10% down in Jan to 7% down in March. So even though we're trading below where we were this time last year, it's a recovering, albeit slowly recovering position. And so when you take those three numbers together, you're left with, across the quarter, 8% down on volumes compared to the Q1 of 2025. Now, it is really hard to tell how much impact the build up to last year's SDLT deadline had on case instruction levels. I think Ben's already sort of touched on it. That there would have been a certain percentage of definitely January and maybe even February's SSTC numbers created by over optimistic buyers, perhaps being encouraged to go ahead and instruct their lawyer on the basis of hoping to get that completion through the door before the end of March, albeit those possibilities would have been very slim and getting slimmer as the time moved on. But so there would have definitely been an impact on those numbers, but it's hard to sort of say how much of that underperformance is down to an inflated overperformance from the previous year, if that makes sense. But nevertheless, as I say, month-on-month upward trend is a positive one. March, as I've already said, recovered to only being 7% down on the previous year. And just for a bit of context, and the reason why that's worth highlighting is when we were looking at maybe last November's versus the November before, that differential was 25%, which obviously was huge. So to say we're only 7% down doesn't sound like such a bad position, particularly one where the trend is an upward one. And then just quickly, because obviously completions, as you'd expect, which shows a completely different picture in terms of activity, because entirely down to the SDLT scramble which culminated at the end of March. And as you say, Mike, no one on watching this will need reminding of that one. But despite completion numbers actually increasing month on month from Jan to Feb to March this year, when you compare to last year's Q1, we're actually, the comparison is as follows. January 101%, so slightly above the number that we completed in Jan 25, slipped down to 91% in February, and a shocking 55% compared to March 25 for completion numbers, which I guess just, highlights in a big highlight pen just the sheer craziness that happened in March 25 versus a more normal situation of this March. We were 55% of where we were in month 3 of last year.
Thanks, Rob. Also raises the question that we often ask when we talk about the stamp duty deadlines: is it activity which is new activity fueled by stamp duty changes, or is it just reallocation of stuff that was going to happen anyway that all falls into the months before the deadline because people want to save a bit of money? And
well, without wanting to spoil our next podcast on the next quarter, as you would expect, we're seeing a completely different April in comparison to April 25, where basically no one moved house because they'd all moved in March.
So the pipeline had squeezed in early.
Yeah.
Brilliant. Thanks very much, Rob. Next, we'll look at the property search trends, which tell an interesting story again when we look at the quarter's activity. So overall search volumes were down 1% in the Q1 when we compare to 2025. But if we look at each of the individual months, we can see the impact on stamp duty for the overall search market. And also it tells a story of what conveyancers were doing over the course of the quarter last year. So January volumes in 2026 were down 17% on the same month in 2025. February was down 2%. But March, we saw a 15% increase in search ordering compared to March of last year. And what that tells us is just how much of the lawyer's time was spent focusing on getting completions through to meet the stamp duty deadline. And therefore, they weren't really ordering searches last March. Whereas last January, they were busy ordering the searches for the cases they were trying to push through to completion before the end of the stamp duty deadline at the end of the quarter. So it tells an interesting story about the workload on the conveyancing community and what that meant for searches and the activity they were undertaking. When we look at this quarter in 2026, there's still a bit of spring demand that's not quite come there yet for reasons that we've discussed elsewhere around economic concerns, mortgage pricing, etc. But we will see as we move into April and May. Next up is me again, and I'm talking about the mortgage valuation approvals. So this is an interesting, very interesting comparison because there are more than one factor impacting the year-on-year results. Obviously, stamp duty will have had some impact on mortgage valuation in a year-on-year comparison. But when we look at mortgage valuation approvals within Landmark, we cover remortgage and purchase activity. So there's a different factor there. And we can talk about the split in a second. But overall, the numbers were strong, up 6% compared to last year on the whole quarter. But there's a really interesting, there's more interest when you dig into those numbers, and the split between remortgage and purchase tells a story that aligns more to what Ben and Rob have been talking about. If we pick February as an example, remortgage activity was up 28% year on year. That's based on Bank of England mortgage approvals. Purchase activity was down 4%. So we can see a subdued year-on-year comparison in the sale and purchase market, but a lot of activity in remortgage bumping up the overall numbers. And then as we moved into March, obviously we had the external factor of the war in Iran, which has impacted oil prices, which in turn has impacted swap rates on the fears that we're now considerably less likely to see base rate falls over the course of this year and going forward, and potentially even things might go the other way. As a result of that, lenders are having to reprice their mortgage rates pretty often as those prices have been volatile, but they're going up more often than they're going down. And what we have seen, the pattern that we've seen in these kind of scenarios, when we look back to the mini budget and we look back to any inflation fears since then, is we see what we call a bit of a storm before a calm, where there's a flurry of activity of mortgage valuation requests as consumers and brokers start to see the writing on the wall that lenders are going to have to reprice upwards. So as much of the pipeline is pushed through as possible to try and capture the lower rate before lenders price upwards. And that's what results in that storm before the calm. It's fair to say that we saw more activity after the Iran war than we did over the mini budget period. So the question that comes from that is whether that was reallocation of activity that was going to come over the next 3 to 6 months, especially when we talk about remortgages, or was that new mortgage applications for people looking to jump on board or commit to a purchase or commit to a remortgage rate before things priced upwards? And similar to how as Rob said, when we start to look at completions into April and May year on year, I think it will be interesting to look at the mortgage valuation activity in April and May year on year to see how much of the flurry of activity that we saw in March was new activity, or was it just things that we're going to see in April and May coming forward to try and save a bit of money? Only time will tell. So that's it for England and Wales. Sat patiently as ever has been Richard Hepburn, the Managing Director of Landmark Scotland. So Richard, thank you for your patience. I will hand over to you to talk about what you've been seeing in Scotland.
Thanks very much, Mike. I think we usually see things slightly less in a slightly less volatile way than England up here. It seems to be the peaks are never so high and the troughs are never so low. I think we've had a more interesting quarter this time round, echoing some of the factors that I think both Ben and Rob have spoken about. One of the lenders I looked at described it as a kind of stop-start market in Scotland, and I think there's been sort of external factors that have influenced that as well. I mean, we didn't have the stamp duty hike last year here, so we're not comparing against something like that. But what we did have was a delayed Scottish budget, which didn't happen until January because of the delayed Westminster budget. And then we're looking forward to a Scottish Government election at the beginning of May in less than a month now. So, what sort of influence that has on the market, who knows, but it may cause some people to pause, it may cause some people to speed up what they're thinking about. But the upshot is, I think we saw listings a bit similar to the way Ben described it, although maybe a slightly different pattern across the quarter, in that we exited 2025 pretty strongly, and that continued into January before tailing off to be sort of level with 2025 by the time we got to March. But overall, we were up 9% in the quarter over the equivalent quarter in 2025 on listings. Our kind of sold subject to missives, sold subject to contract, that actually fell 7%. So it's got some parallels with the south as well, suggesting lots of stock around and maybe favouring buyers more than sellers at the moment. Completions were down 5%. And then our kind of final external factor we look at is the Registers of Scotland registered sales figures. Now, they lag our numbers a bit, so they're probably more reflective of the sort of carryover from the end of 2025. So they were actually showing that they were up 3% in January, but we don't have realistic numbers yet to look at. So a similar picture really, in the sense that listings are up, sort of sales are down, and through to completions been slightly down as well.
Thanks, Richard. And then when we look at some of the other ratio metrics that we measure, so Ben talked about demand supply variance. Can you talk us through how that's looked in Scotland?
Yeah, so I think very much the same pattern as Ben, very much a buyer's market. So we're seeing percentages higher on the supply side, and that kind of really troughed on the demand side in February before bouncing back, but still really tracking, adverse to the supply, so selling nowhere near parity on that, as Ben suggested, which is a normal, healthy market. So, yeah, not much more to add to that.
Thank you very much. And moving on to search trends, what did they look like?
So searches were, basically in terms of legal reports, which we do at the time of the sort of agreed sale. As I said, they were, really tracked down. That kind of 7% number I talked about before was reflective of that. And again, February was particularly poor before really seeing a bit of a bounce back in March. Now, whether that's just a normal pre-tax year-end sort of bounce, lots of things like plot sales coming through as house builders try to get sites off their books in time for the new financial year. So we'll see where that continues on beyond the kind of Easter period and what the impact of Iran is on that.
Fantastic. Thanks, Richard. And anything else to finish off with in Scotland you'd like to mention?
Just I think one other thing that's definitely been coming through in feedback, we've not really seen it massively in our numbers, but certainly there's a reporting back more instances of chains than we usually see in Scotland at the moment. So that's usually a sign. I think the wider economic issues probably trump the sort of local issues with Scottish elections, etc. So it is about affordability and interest rate expectations. Those same constraints and influences will be on people here in exactly the same way as they are in England. And I think that's really what we're seeing, and that's probably leading to more sales subject to or offers subject to sale than we would normally see in a normal Scottish market.
That's interesting. Thank you very much, Richard. And I'll just quickly close up by thanking all of our panellists today, Richard, Rob and Ben. Appreciate your time and insight as always. Thank you very much to everyone who's listening and who's listened. You can find our Property Trends Report, which is an all-new digital Property Trends Report, on the Landmark website at landmark.co.uk. If you head to the News and Insights section and click on Industry Reports, you'll be able to see the Property Trends report there, along with lots of other interesting insight that's published by the team at Landmark. Thank you very much again for listening. Look forward to next time.
Thank you for listening to Landmark Talks Property. If you've enjoyed today's podcast, please hit subscribe. This podcast is for general purposes only. The views expressed are those of the hosts and guests and do not constitute professional advice.